What's going on, YouTube? Welcome to Risky Ryan Trades. Today we have the much awaited perfect portfolio. This portfolio, if you had it over the last 10 years, would have returned you 30% per year while having a drawdown. That means that the portfolio would have went down less than the S&P 500. So you would have had over double the return of the S&P 500 while suffering less drawdown than the S&P 500. So this is something I've been searching for, researching ever since the big crashes that we've been having lately. It's made me really think about, the portfolio balance in my account and trying to find something that'll outperform while not being so risky, which is a little off-brand for Risky Ryan Trades. But with that being said, trading is risky, so here's my disclaimer. This is not financial advice, my opinion only. Trade at your own risk. Trading comes with risks, but hopefully you find some value in this video. And if you do, why don't you hit me with that like, and your comments are always appreciated as well. All right, without further ado, we're going to get into my research. So before we can determine if something has outperformed the S&P 500 and has less drawdown potential, first we got to actually, take a look at what the S&P does. So over the last 10 years, the average annualized return is 12.8% per year, with a max drawdown of 23.9%. And I also wanted to take a look at the Nasdaq, which gives you higher returns, but has higher drawdown potential. So you got an 18% annualized return for the Nasdaq with a 32.6% max drawdown. Now, these numbers come from Portfolio Visualizer, which is the tool that I used to crunch all of this data. It may be a little off. When I looked at the charts, like the COVID crash was more than, a 23.9% drop. So I don't know exactly how they're calculating this, but at the same time, it's all benchmarked. So it's all from the same source. So it will still be valuable information. So let's take a look at some of the top ones. So, United Healthcare was an interesting one. United Healthcare returned over the Nasdaq while having less drawdown than the S&P 500 throughout those 10 years. So that makes the list. Eli Lilly crushed it, especially lately. 31.8% annualized return with 20% max drawdown. Costco, my biggest holding in my Roth, and I've had this for the last 10 years, thankfully, beat the Nasdaq with less drawdown potential. Microsoft, crushing it, 27.7%. This had a in between the Qs and the S&P 500 as far as drawdown. Same with Apple, similar risk to return profile. And then here are some names that you might not have expected to be on here. Progressive Insurance, absolutely crushing it, 27.4%. with the lowest drawdown over the last 10 years out of all of them, 15.1% max drawdown. FICO crushing the returns, 38.2%. That's double the Nasdaq return with the same risk profile as the Nasdaq over the last 10 years. Some other important names to mention, you do have Texas Instruments hitting Nasdaq-like returns with lower than S&P 500 drawdown. You've got MasterCard beating the Nasdaq with less than Nasdaq drawdown potential. Linde, a materials company with Nasdaq-like returns, but a very solid risk profile. And then you have a couple other names that made my list because I want to have some industrial exposure. And you got Lockheed Martin, which absolutely solid, 14.4%. annualized return with a 24% drawdown, and Boston Scientific beating the Nasdaq with less than Nasdaq like risk. Then you also have some of the high flyers. So you're going to have the semiconductor industry, 27% returns, but that one comes with more risk. Has a 40% max drawdown in the last 10 years. Some other names here. Amazon, 29.7% return, but 52% max drawdown. Nvidia, obviously high risk, high reward. You got a 77% annualized return with 62% max drawdown. So you get as much as you give with this one. Bitcoin, similarly, 74 to 73. Meta, which I do think will do better in the future, 20.8% with obviously there was that huge drawdown in 2022, 77%. I do think that this is behind us, so I'm not too afraid of Meta. Netflix, similar, 30.6 to 74. And then Spotify, a company that I'm curious about going into the future, 22% annualized return with a 74.9%. So taking a look at this, the way I went about building the perfect portfolio is I used some of these high return, low risk stocks as sort of anchors for the portfolio to sort of stabilize things. And then sprinkled in some of these high risk, high reward plays as smaller positions within the portfolio. I also dove into some of these names to see if there was any stocks that, like stock pairs. So if I combined one stock with another, did it really offset the drawdown? So like one went up, the other went down, and then the other went up, the other one went down, but like they both went up over time without dropping your whole portfolio. So let's dive into some of the interesting findings that I found. So first thing that I found, Costco and United Health Group did a really good job of reducing the drawdown potential. Look at that, 11.7. Keeping in mind, that's half of what the S&P 500's max drawdown was, while beating the Nasdaq. So these two stocks, they do, at least over the last 10 years, they have paired well together. And this shouldn't surprise you. Costco is a consumer staples stock, and United Healthcare is a healthcare stock. These are defensive positions in a portfolio. These do well in recessions. These do well when things aren't going well. But Costco does really well when things are going well, and United Healthcare seems to do pretty good when things are going well as well. So these two names are, from what I can tell, really solid overall all-season investments. Another pairing that went really well was Microsoft and Eli Lilly. Even better than those two, you get a 30.8% return annualized over the last 10 years with a drawdown of only 11%. Incredible. Mix them all together, and now you have even less drawdown, 9.2%, with a portfolio return of 27.0%. So how did these do on the graph? So portfolio number 2, Eli Lilly and Microsoft did the best, followed by portfolio number, which one is that? 3, it looks like. So, the combination of them all. And then you have the sample portfolio. So that was Costco and United Healthcare coming in third, but a distant fourth place was the S&P 500. Look at that. Now, wouldn't it be nice if you could just invest in 4 stocks and call it a day? But I don't know about you, but that's kind of highly concentrated. Like, yeah, I get that they've done well in the last 10 years, but I don't want to have just 4 positions. That's not diversified enough for me. And so after playing around with those names that we went over, the MasterCards and the Apples and the Amazons of the world, I discovered this portfolio. which returned 32% over the last 10 years with a drawdown of 15.2%. So yes, a little bit higher drawdown, but much higher return, and still less drawdown, less risk over the last 10 years anyways, than the S&P 500 itself. So how did this break down? And what did I discover? So I had the big four as 10%, Costco, United Health, Microsoft, Eli Lilly, then Progressive, Apple, FICO, MasterCard, and then the sprinklings of more high risk, high reward. You've got a 5% to Meta, 5% to Amazon, 7% to the SMH, which is the semiconductor ETF, 1% to Bitcoin, and 2% to Nvidia. Now, is this going to be my portfolio going forward? No, but there are a bunch of names that I was never considering, like Progressive and FICO, that are now very much on my radar. And I actually have added FICO to my portfolio this week. It might be a little too soon. There might be another drop or something. You know, the markets are really choppy right now. But I felt like the setup was really good, and the trade, I'm already up 6%. So on accident, I timed it perfect. Progressive, I'm taking bites out of. And before we end this, you got to take a look at some of these charts, because a lot of these positions comes with a caveat. So let's take a look at that. First up, we have Eli Lilly, which I am very keen to regain a position in. However, the recent drop does give cause for pause. Now, obviously, this has been ripping since 2019. And if you compare the bar chart, you can see that it basically tracked the S&P 500 for the first 5 years of the last 10-year period, and then it really separated from it, like in a big way, a very big way. Now, is it too late to get into this name? Maybe. However, based on that study and seeing what the max drawdowns are, the current drawdown that we are at is one of the larger drawdowns of the last 10 years, meaning that maybe, perhaps, we might be at the bottom of this current drop down and going up for the next parabolic move up, which I'm hoping for. Obviously, hope doesn't get you very far in these markets, but you do have to have stocks that you have high conviction in. And Eli Lilly is a blue chip stock. It's going to be on the forefront of all the biotechnological advances in healthcare going forward. So I do feel good about this stock for the next 10 years. And let's take a look at the charts here to see where it's sitting as far as moving averages. Now, this is a monthly candlestick chart. And what you see around it, these lines, these are, this is a Gann square. So they show you key levels here. You can see once it had trouble breaking through, then it broke through, retested. Once it got through the arc, it kind of like wanted to be by it, and then it pushed up, couldn't get through, busted through, fell back through. So in this move right here, look, it went through 1, 2, 3, 4 levels of resistance in the Gann square before coming back down through 1, 2, 3, 4 levels of resistance. Do I think this thing is going to drop all the way down to the angle again? No, I do not. Is it troubling that it's not yet over this Gann level? It is, but on the monthly, you can see it's still holding Tenkan-sen. As far as a long-term investment, something that you might hold for another 10 years, this thing isn't done yet. Now, this candle is not formed yet, and earnings is on Thursday, which if you're watching this on Thursday, it'll be interesting to see where it lands. Now, this is a monthly chart. On the daily chart, it looks a lot uglier. it's below the cloud, below all these levels. And, you know, it tried to get back up over, you know, this GAN level, and it failed. And now it's red again. But earnings tomorrow could change everything for this stock. Could change absolutely everything for this stock. And part of me hopes that it trades down. If I can catch it down here at 720, I'm going to pick up more shares. I'll probably pick up shares either way, to be honest. But I'm going to wait till after earnings to pick up more of my position. You know, because there's a chance I might be able to get them cheaper. But if it pops up over this, I won't be upset missing the boat or anything, because I do have a partial position, and I'll be happy to see that it retakes this level. On the weekly, obviously that's gross. It's a little gross, but yeah. So I mean, really, the moral of the story on this name is you got to wait for earnings. Let's take a look at Costco. On the weekly, we found support on the Kijinsen this week. And so I would suspect that this fib channel is in play. And yeah, I mean, we hit these levels and it went perfect. And it's one of the stronger ones this week so far. On a monthly chart, I see nothing but price rejection so far for the top of this candle. Yeah, we went under it, but you know, it's not closing under it. And so who knows? We could try to get into this arc next week, as soon as next week, potentially. Or next month, I should say. This is a monthly chart. Taking a look at bar chart. Costco over the last 10 years, consistent outperformance compared to the S&P 500. You know, as I scroll, there's brief periods where, you know, it underperformed, but yeah, I mean, look at this. At all times, it was doing better. And you could have bought at any period in the last 10 years, and today you would have been ahead of the S&P 500. So Costco, beautiful, beautiful stock to own. Yeah, it's got a high valuation, but it's earned it. This thing ain't going bankrupt. It grows during bad times. It grows even more during good times. Let's take a look at United Healthcare. United Healthcare is an interesting name. Over the last 10 years, obviously some high outperformance out of it. There were periods of time, you know, like if you had bought right here, you would have been underwater until the stock market peaked. Everything started to sell down, and United Healthcare did well because it's a defensive name. If you had bought at the bottom, that would have been the wrong time, and you know, you'd be way under. But so United Healthcare, the thing about that is, you know, like if you go to a peak, any of these peaks, or sorry, the peaks of the S&P 500, you actually did better. So right now, I mean, we're kind of near a peak of the S&P 500. It's kind of doing a down wave at the moment. So, and you see that this is popping off. So United Healthcare, strong name. Taking a look at the chart, it's a little extended off the moving averages at the moment. But it's broken this range. It's broken this range, and you know, it's already retested the top of this and bounced up. Taking a look at the weekly, you know, also a little extended, but this can happen. You know, it might go sideways and then up again. But yeah, we are consolidating higher at the moment as fear enters the markets. Looking at a daily chart, we did close under Tenkinson recently on the daily. So waiting to enter a full position might be a good call, like waiting for this to get above. And that's what I've done. I actually currently have the rest of my United Healthcare position in AbbVie, because I get the same defensiveness, but it's currently good on the Ichimoku on the daily. So I'll be waiting for this to give me a buy signal and potentially moving my AbbVie over. or maybe just keeping it that and reducing my current cash position that I have going into the volatility that we are seeing right now. Finally, Microsoft can't be ignored. Right now, I mean, talk about buying at a discount. This thing's sitting at $400. You know, yes, it's now rejected off of this Gann angle and rejected this. So there is probably some pain going forward for tech. I don't think that this is the bottom. I just don't. I've been given no reason to believe that we're really only up from here. You know, I think this continues and we see potentially a 370 Microsoft. That being said, I have a full position in this, and like I'll just ride it out because it's Microsoft. I'm not worried about going bankrupt or nothing. You know, in the long run, Microsoft wins, right? Also, it doesn't have a crazy year to date like Nvidia, so you know you could see in the second half this thing just absolutely rip up, which I'm hoping for. I'm not going to go through every single one of these, but there is one in particular that caught my eye, and it is Progressive. I want to show you this chart because it is pretty fascinating. I'm going to take off the indicators. I'll bring this back to 10 years. And you can see this thing sure looks like it's about to go, like it's already begun going parabolic. We're in a tight formation here. If this goes parabolic one more time, I mean, this move was an 80% gain. I mean, if we get another shoot higher, 50%, I mean, maybe this is a pipe dream that I'm talking about here, but this looks like a really healthy chart to me. Really healthy chart. And what I like about it is I like some financial exposure, but I don't like banks very much because they fuck up our economy. But insurance gets you that. And Progressive, I don't know about you, but it's so easy. It's an online thing. Like you can sign up. You don't have to talk to an agent. Like it's the easiest thing. And I think that's why we're seeing some growth. Say you hate Progressive. Travelers also giving me a similar signal. Now let me go to a weekly. Travelers looks like it's prepping to go parabolic on us. Let me bring it to 2014. So Travelers Insurance looks pretty solid as well. Allstate's chart does not look like this. And then I do want to show you FICO as well. FICO has had a crazy run. It's already, done the second and third parabolic move. I mean, so, it does make me a little nervous, but at the same time, the fundamentals of this company are just really solid. And like, it'd be pretty ironic if a credit score company went bankrupt, wouldn't it? So I don't think that's going to happen. So FICO, I already have a position in this now, so full disclosure. Anyway, I don't want to keep you guys too long. I hope that you found that really valuable. If you're still with me on this video, it tells me that you must like my content. So maybe consider hitting the subscribe button down below. There's also probably an icon showing up right about now. Your likes and comments are greatly appreciated. If there's a name that I missed, I would love for you to comment that below so that I can take a look at it. But yeah, thank you so much for everything, for watching this video, and I'll catch you on the next one. Risky Ryan, out.